In this video, I discuss the critical 5-year window that determines if your retirement survives a market crash. Coming up next on Holy Schmidt.
Holy Schmidt!
There's a specific window of time in your life where a market crash can do permanent damage to your retirement, and most people don't even know that this window exists. Retirement researchers call this the retirement risk zone, and according to an interview published in Morningstar in April of 2026, this period of time is 10 years, 5 years before you retire and 5 years after you retire. Now, to be clear, a market crash at any point in your life isn't fun, but the math shows that the retirement risk zone is far more dangerous than the same type of crash happening, say, 20 years into your retirement or 20 years before your retirement. Today, I'm going to show you why this is the case, and more importantly, I'm going to show you exactly what you can do to protect yourself. All right, let's get into it. First, let's talk about what most people get wrong. That is, if they average a certain return over a period of time, it doesn't really matter whether that return happens at the beginning, middle, or end of the period. So if someone averages a 7% return over 30 years, well, when that happens, they're fine, even if there are a few crashes in between. But Wade Pfau, one of the most respected retirement researchers in the country, says that it in fact does matter, and a 7% average over a period of time is oversimplifying it. What matters most is the sequence of those returns and when the bad years hit relative to when you start spending. Think about it this way. If you invested a lump sum of money at age 35 and left it there for 30 years, the sequence of returns wouldn't matter at all. You'd have good years and you'd have bad years, but as long as you didn't touch the money, you would end up at the exact same ending point. The math is simple. You just let it compound. In good years and in bad years, if you have an average return over a period of time, you're going to end up in the same spot. But the moment you start withdrawing from your investments, the timing does matter. And the moment that you contribute more to your investments, the timing does matter. JP Morgan illustrates this perfectly in their guide to retirement. They modeled 3 retirees, all starting with $1 million, and all averaging the same 5% return over 30 years. The retiree who got bad returns early and good returns late ran out of money. The retiree who got good returns early and bad returns late ended up with over $1.5 million at the end of those 30 years. Same average return, completely different outcome. The only variable was timing. Now here's something that surprises a lot of people. The retirement risk zone doesn't start the day you retire. It starts 5 years before you retire, maybe even 10, depending on what's happening in the world. Why? Because when you're in your late 50s or early 60s, you've accumulated most of the wealth you're going to accumulate, absent you selling a business or something like that. But for the average person contributing to a 401k or other retirement account, by the time they get to their mid to late 50s or early 60s, that is the balance, or largely the balance that they have to work with going forward. Which means market volatility during your final years before retirement has a huge impact on your nest egg, even if you haven't started withdrawing yet. Pfau put it plainly, a 7% return basically doubles your investment every 10 years. And if you have a sudden market decline during the last few years, that alters the trajectory of your portfolio completely. It takes a chunk out of your base from which your nest egg was supposed to grow. The same logic applies in reverse after you retire and you start to draw down funds, because if you have to sell your assets at a discount at a price below what you paid for them, well, you have less to work with and less to grow in the future. That combination of peak savings, active withdrawals, and market volatility is what makes this 10-year window uniquely dangerous. It's not that a crash at other times doesn't hurt, it's that a crash in this zone can dig a hole you simply can't climb out of. So what do you do about it? Well, Pfau says that you should start actively reducing risk in your portfolio years before you retire. Not months, but years. Not because volatility is bad. In general, it's actually quite good for a portfolio if you have a long-term horizon. But it has asymmetric risk as you get closer and closer to retirement. You have a lot to lose and not enough time to recover. Target date funds do this automatically. When you have 20 or 30 years ahead, the fund is invested largely in equities. But as you get closer and closer to the target date, the date where most people plan on retiring, more or less, the shift happens and the portfolio goes from largely equity to a more balanced combination of fixed income and equity. Pfau points to another approach that takes us even further, time segmentation. For example, if you're 10 years out from retirement, you don't buy a bond fund, you buy an individual bond with a 10-year maturity. And every year you keep buying another bond with a 10-year maturity. So when it comes time to retire, the bond that you bought 10 years ago is the first to mature. And as you go through the beginning years of retirement, you have income that is guaranteed with those maturing bonds year after year. These bonds are completely separate from your equity investments. And by the way, it's not that equity investments are bad, it's that timing may be the problem, not the investment itself. The point is that the closer you get to the retirement risk zone, the more important it is to have a portion of your assets that don't require the market to behave when you need the funds, when you need to spend the funds. The next one surprises a lot of people. Conventional wisdom says that as you approach retirement, you should own fewer stocks. You should become more conservative in your investments. Faust studied this and found something interesting. Conventional wisdom, applied in a specific way, can actually increase your sequence of return risks in early retirement. Here's the dynamic. If you arrive at retirement and you have a conservative split, say 30% equity, 70% fixed income, and markets recover later, you don't get to participate in a large part of that recovery. You've protected the downside, but you've capped the upside at exactly the wrong time. What Fal found is that a rising equity glide path, starting conservative at retirement and then gradually increasing your stock exposure over time, can improve outcomes and reduce failure risk in certain scenarios over a full retirement. The logic makes sense when you think it through. Your early years of retirement are when the sequence of return risks are the most dangerous to you. So you lower your exposure to reduce volatility. Once you've cleared the early retirement hurdle and you're in mid-retirement or late-stage retirement, well then taking more risk actually might make sense. You can afford to take on more risk because your portfolio has stabilized and your spending patterns are highly predictable. Fal is clear that this strategy isn't for everyone. He doesn't push it as a universal rule, but the evidence supports it as a real risk management tool for those that are comfortable actively managing their portfolio over time. Here's a specific application of the retirement risk zone for people that do everything right but get it wrong. You've probably heard, including on this channel, that delaying Social Security to age 70 is often the smartest claiming strategy. The benefits grow by about 8% for every year you wait past your full retirement age, and for most people, this is genuinely good advice. But here's the catch. If you retire at age 62 and you delay claiming until age 70 and you want to live on, say, your 401k or your IRA, that 8-year window has risk attached to it, particularly if the markets aren't doing well, because you've decided not to claim Social Security, and so you're selling your assets in your 401k at a price lower than you should or you could if you waited a few more years. Fal's direct about this. He says that this isn't an argument against delaying Social Security. Usually that is the right move. But you can't just delay and hope that the market cooperates. You need what's called a Social Security delay bridge, a separate resource that replaces those 8 Social Security years, and that resource is less exposed to market volatility. What's that look like in practice? Well, Fal prefers what's called a TIPS ladder. What are TIPS? Treasury inflation-protected securities that mature on a schedule to replace your missing benefit year by year. He also mentions other options if a TIPS ladder doesn't fit your specific situation, a part-time job, for example, or even a reverse mortgage under certain circumstances. The specific tools matter less than the core principle, and that is don't leave 8 years of portfolio risk on the table when you can do something to mitigate that risk. There's also a behavioral risk that Fal talks about, which JP Morgan confirms. It's not just about the math, it's about how retirees behave when markets become volatile. JP Morgan's Guide to Retirement shows that retirees with more guaranteed income from Social Security, pensions, or annuities tend to feel more comfortable spending. They can maintain their lifestyle in a down market without panic because they know a portion of their income is simply not at risk. Contrast that with a retiree who's entirely dependent on their 401k and market behavior. When the market drops 25%, they pull back on their spending. They have to pull back because if they don't, then their spending is going to eat into more of the principal than they had planned. They do the exact thing that locks in losses, that makes a sequence of return risk even worse. And so Fal's framework keeps coming back to the same theme. In the years surrounding retirement, the goal is not to maximize returns. The goal is to build a retirement income structure that is resilient enough to survive a bad market at the worst possible time. Returns can help you get wealthy. Structure can help you stay wealthy when things start to go wrong. Gang, the market doesn't know when you're going to retire. It doesn't know that a 30% drop at the worst possible time isn't good for you, and that you've spent 30 years building your retirement nest egg. The retirement risk zone is real, it's specific, and it's something that you can plan for. The 3 things that research say matter the most are these. First, start de-risking your portfolio in the years before retirement, not necessarily by going all cash or abandoning stocks, but by building a layer of income that doesn't depend on the market being cooperative right when you stop working. Second, if you plan on delaying Social Security, build a bridge so that you're not selling your assets at a bad time into a bad market. Third, recognize that a rising equity glide path, starting off conservative in retirement and gradually increasing exposure to equities, is a strategy for some people, and it's one that works if you know how to actively manage your portfolio. The math on this isn't subtle. JP Morgan's study of 2 retirees with $1 million over 30 years, one ran out of money, one ended the 30-year period with $1.5 million, just simply based on what was happening at the market at that point in time. The only difference was timing and whether their income structure could support them while they weathered the storm. Now, here's what you can do to protect yourself. If you're 5 to 10 years away from retirement, look at your bond allocation and ask whether you're holding bond funds or whether you could be holding individual bonds that mature on a schedule. Bond funds are fine, but a bond ladder gives you something bond funds can't: certainty about when the money arrives. That certainty is worth something when you're in the risk zone. If you're planning on delaying Social Security, say to age 70, that may absolutely be the right move, but sit down and model what your cash flow could look like, what your permanent cash flow, what's your guaranteed cash flow over that period of time, and look for ways to improve it. If you're already retired, FAO's rising equity glide path is an idea worth considering. If you arrived at retirement with a conservative allocation and have been holding it flat or reducing it further, you may be undershooting on growth in the years when you're no longer in the danger zone. None of this requires you to predict the market. In fact, the whole purpose of this is so that you don't have to try to predict the market. You build a structure that can survive a bad market at the worst time, and then you stop worrying about it. If you like this video, check out that video, The Moment Your Portfolio Earns More Than You. This is Jeff Schmidt, and I will see you in that video right there.